Good morning, ladies and gentlemen, and it's a pleasure to welcome you all to the Grange Hotel and thank you for your attendance this morning for the inaugural Barclays Margin FX Trading Seminar. My name is Peter Jennings. I'm pleased to be standing in front of you this morning. I'm a very small part of the Barclays Margin FX trading team. My history in FX spans over 30 years, man and boy. I have worked for some major institutions, banks and global money brokers in my time in the foreign exchange arena. And I have been privy to some of market moving scenarios. And scenarios, being a Greek word, leads me on to the time when I was employed at a Greek bank to implement and oversee the drachma's entry into the Eurozone. On my first day in a trading room in London, I turned up this Greek bank. Greek interest rates at the time were 19.5% and had been so for several years. Double-digit interest rates in Greece had been the norm. But in just over a year, the Greek managed to enter the Eurozone at an interest rate of 3.5%, ticking a load of the boxes on the way through. And it is well known that we have some very major difficulties in the Eurozone as we stand. And some of those currencies are experiencing difficulties, whose rapid road to entry into the Eurozone may have been too fast. And with the Euro, I have seen a fair amount of volatility. Again, I experienced firsthand real volatility when sterling crashed out of the ERM. In one trading session, I witnessed sterling interest rates move from 6, 10, 15, only to settle at the end of the day at 15%. The following day, to see them cut back to around a 10% level and rest there for a few days, only to settle back where they started at 6%. And that similar situation happened in the spot markets, where major institutional banks and money brokers were quoting big figure spreads, i.e. 150 to 151. No small bits involved there, just 150, 151. And requotes were trading at 100 points a clip, up and down. That is very, very scary stuff. And that happened over a period of 2 or 3 days. And one thing as a trader you don't want to have an out trade. You have to make sure that all your details are correct. Because if you have an out trade, that could be very, very, very costly. And that, in my opinion, is volatility. Barclays Margin FX. We launched Barclays Margin FX back in September 2012 with our partners FXEM. Barclays Margin FX brings you a unique retail foreign exchange offering, combining advanced trading technology with professional analysis, cutting-edge research, and a no-dealing desk model. With the no-dealing desk model, you get no restrictions, no requotes. Plus, you get a 24-hour support desk. And lastly, and most importantly, security. The reassurance that you are trading with a global foreign exchange bank with over 300 years financial experience. Today's trading event is the first of a number of events that Barclays Margin FX will be bringing to you in the coming months. We have already hosted 2 webinars, and moving forward with this, we will be hosting these webinars on a monthly basis. A full schedule will be published on the Barclays Margin FX website. This morning's event consists of 2 presentations with a small break for tea and coffee, plus an opportunity for you to have a personal walkthrough on the Barclays Margin FX platform. The first presentation into day trading will be delivered by Alejandro Zambrano, the trading specialist at Daily FX, covering some of the aspects that you'll encounter when you trade daily in foreign exchange. A very interesting session for those day traders. After a brief break for refreshments, we will move on to the second presentation. FX Outlook, a great rotation underway, delivered by Barclays currency expert Peter Kapata, assessing the outlook for major currencies, sterling, euro and yen. An engaging session for the long-term thinkers and traders. Both presentations will cover their subject matters in great detail. Short-term, long-term approaches to trading foreign exchange. These different approaches, opinions, views make the backbone of the forex market. One man's trash is another man's treasure. In other words, what appears to be invaluable to one will be valuable to another. The idea behind today's event is that you benefit in some way, enhance your trading knowledge, gain insight from subject matter experts, ideas for different trading strategies, or just a chance to voice and ask questions to foreign exchange professionals. My colleagues and I from Barclays Margin FX will be in and around the room or at the laptops. So please, if you have any questions, come and say hello. So, ladies and gentlemen, sit back, buckle your seatbelts, and enjoy the next couple of hours. And I'd like to welcome our first speaker, Alejandro Zambrano, foreign exchange strategist from Daily FX.
Thank you. Thank you. All right, welcome. My name is Alejandro Zambrano, and I work as a market analyst at dailyfx.com. And I hope, as Pete Jennings was saying here, that you're ready. I'm going to share with you some interesting facts about intraday trading and some facts that has not been published as far as I have seen online or in any books. We looked at pretty much 1,437 trading days, and I asked one of our engineers to, with help of time, see where most highs and lows are created on an intraday basis. We also looked at what price level most highs and lows are created on an intraday basis. And these are two topics that we're going to cover today. So I'm going to give you a couple of tools that hopefully can enhance your intraday trading. But for you guys that are new, I am going to introduce you to what intraday trading is, what the benefits are, but of course the risks. But before we start, I want to show you the risk disclaimer. As you might know, we're putting our money on stake, and hopefully if we put our money on stake in a good way, we'll be rewarded with a good return. But unfortunately, because we're putting our money on stakes, there's always a risk that we'll lose all of our invested money. So please bear that in mind before you start trading. There's no free lunch, especially not in the currency markets. Okay, so what are we going to cover today? We're going to cover what is intraday trading. I'm going to explain to you with a simple system or simple method why short-term trading offers more opportunities than long-term trading. We're also going to look at using the overall trend to know if we want to buy or sell on a given day. And then we're going to look at what I mentioned earlier. We're going to look at something that I have not seen published before, and that is how price and time, how there is a relationship between price and time when trading the London range or the London trading session. We're also going to talk about a special system, well, very simple, but it's called London range breakout. We can use this to trade, but also to determine with higher likelihood where the high and the low of the day is going to be. And then, as I mentioned before, we're going to look at profit targets with pivot point levels. We looked at pretty much 2,000 trading days. And I'm going to reveal to you what we learned by looking at 2,000 trading days on where the high and where the low is being created. Okay, so we'll begin, and we'll begin with intraday trading. Not all of you guys might know what this is, but right now we're looking at the Market Scope 2. which is the charting software you'll get with the Barclays Margin FX. If you have that, you will have these charts included there. So what I did is I plotted the euro versus the dollar. You can see that to the very top, and we're looking at a 5-minute time frame. And we're pretty much looking how price evolves over time. Down here we have volatility indicator that measures how the volatility is throughout the day. And intraday trading is actually quite simple. It's all about deciding where to buy at the beginning of the session, which starts pretty much at 6 in the morning, and closes position sometime in the afternoon. Right now I took from 6 in the morning until about 5 in the afternoon. There's really no fixed start or opening like the stock markets. But usually around 6, 7, 8 o'clock, we start to see some activity. And we can clearly see here that the activity remains low during the Asian session, very low activity, and then pick up. So why is it interesting to trade intraday? It's quite simple. If you would buy pretty much at the session low and sell at the session high, you would have a range of about 100 pips. But as you can clearly see here in this chart, we have a move of about 40 pips to the downside, 40 pips to the upside, then a decline by 15, and then a move up higher about 35, and then we have another decline of about 40, and then we have a rally of about 68 pips. So we have a movement within the trading session, and if one would be good enough to capture all of these highs and lows, then by the end of the day, that trader would have gained about 220 pips compared with someone that would just pick the low and the high. So that's why many people go into currency exchange markets, because we have this volatility. If you don't have volatility as a trader, you can't really make money if you're speculating on the price change. So you need to have that volatility, and that's why so many people are attracted to this. But of course, with opportunities, you also have risks. So that's intraday trading pretty much. Buying at the beginning of the day, selling at before the end of the day. Some people will call it scalping. They will do short-term trading within a day. As you can see here, we have three legs to the upside. 1, 2, 3. Some people are just going to look for maybe a tenth of the movement that we have throughout the day, and that's what scalping is called. So this is the matter we're going to talk about. We're going to talk about when those session highs are being created. We're also going to talk about the direction. We're also going to talk about at which price levels most of these highs and most of these lows are being created. Here's another example. I mean, the first example was quite obvious. You had a lot of ups and downs throughout the day, but here's another way of measuring the same thing. Imagine that you are long-term traders, quote unquote. In this case, you want to take on a position in the beginning of the week and sell it by the end of the week. On average, you'll have a volatility of about 240 pips in the euro versus the dollar. So you have about 240 pips, and imagine that you know exactly where that low is going to be created, and you also know exactly where that high is going to be created, and then by the end of the week, you will have generated about 200 pips. Say that you instead want to do intraday or a 24-hour trading. You have the ability to pick the high and the low on a 24-hour basis. If you would do that, and you would do that successfully over 5 days, then you would generate 535 pips. So as you can clearly see here, it's a special market in a sense that there is a window of opportunity here, which is the 24-hour period, where you have a lot of volatility that if we could just work with that, imagine that you just trade 2 times per day instead of holding the position for 5 days. Risk adjusted, if you look at time, you would have a lower risk by trading more short term. And if we would take this even a step further, and we are looking at scalpers, and these guys, they have the ability to find the low and the high on a 4-hour time frame. Now these guys, they will look for about 40 pips per move. Imagine that you have that ability. So if you have that ability to predict the high and the low over a 4-hour window, by the end of the week, we would have generated about 1,200 pips. There are, of course, major risks with the short term. Staying somewhere in between is usually the best solutions. But this just clearly shows the possibilities that we have in short-term trading and how this market maybe differs a bit with other markets. Okay, so now we know what intraday trading is. We know how we can compare it with more long-term trading when it comes down to opportunities. We're now going to talk about how to have a rough idea on if we want to buy or sell the markets. Sorry about that. What are we looking at right now? We're looking at the basic definition of an uptrend. Very powerful, very simple. We don't really need to complicate it more than this. You've probably seen it yourself. The more experienced you become, and if you look at more experienced traders, they will look at very few indicators. They will just look at price, and in their heads, they have like an algorithm which is going to give them a clear view if they want to buy or sell. There, of course, you can definitely use indicators, but this is just the most simplest version of an uptrend, which I like the most. It basically says that as long as we're creating higher and higher lows and higher highs, then we should expect a further move to the upside. So if you see this on your charts, don't try to sell this move. If you clearly see that we're going up, you should look to buy. What else? If you think about it, if we're indeed in an uptrend, then the next low should not be under the higher low here. Now that's your risk. So if you're trading here and it's 50 pips to the next low, then you know that 50 pips is going to be your risk. Remember that. In an uptrend, we need to respect the higher and higher lows. That's going to give you an exact level of what your risk is. What else? In an uptrend, what can you also assume? Well, don't be selling yourself short. The high is here. Everyone can see the high. But in an uptrend, what do we do in an uptrend? We create higher and higher highs, right? So don't assume that we're just going to go up to the prior high. Be a little bit brave. Look for the next high. It's as simple as this. Is it always going to work? Definitely not. The trader that can endure drawdowns in their account is the one that's going to be a winner. But if a trader always looks at this and works with it and assumes that, then he can reach very, very far. So what do we know about the overall trend? Well, we do know that markets tend to respect the swing lows and swing highs in the 30-minute time frame. So if you look at your trading platform and you switch to the 30-minute time frame, you're going to see major highs and major lows, and usually that happens to be the swing high and swing low from the prior session. So you're going to have the low from the previous London session, and you're going to have the high from the previous London session. You're going to see that those are levels that are usually being respected. And those are the main levels that I usually look at when I'm trying to help people if we should look to buy or sell. So what you want to start out with, you want to look at your time, you want to look at your platform, you open up the 30-minute time frame, and if you see that we've been going up for 2 to 3 days, look to see that continuing. There is, of course, a limitation on how far things can rise. And statistically, we haven't really seen that price can continue to rise for more than 5 days in a row, with the exception, of course, of the dollar-yen, and that has had a very nice rally lately. But on average, look for this. This is a simple, basic definition, doesn't involve any trend lines. If we are creating higher and higher lows, as we can clearly see here, then you want to buy. This is a 30-minute time frame again. This is about 3 to 4 days of data. We can clearly see here we've been going higher. We can see that every time we go against the trend, we don't really make so much. We don't make so much in return. However, if we go with the trend, we tend to have maybe a slower period, but then we have price just going straight up. So this is exactly why we want to look to buy here. Now I put there's another stuff here, there's the pivot point indicator, which I'm going to introduce you to guys later. But if I'm looking here at the 143 level, how come I draw an arrow from this high down here and expect us to go higher? Does anyone know why I draw that line at 143? Nope. It's just because, in this case, we're in a short-term uptrend. We're creating higher and higher highs, and I know that when we take this out, then this short-term move that we have here to the upside it's not going to be bullish any longer. It's going to be in the beginning of maybe reversing, but most likely just going to be flat. If we take a look at another example, same situation, but this is very, very straightforward. I think if you ask anyone here which direction this price is going, it's going up, right? And you see what is a so-called double bottom. It's okay. We can clearly see here that this level here separates us from the next low, which is down here. So this is a wide, fairly wide distance here, about 100 pips to the downside. So if there's 100 pips to the downside here to make, if we break here, then that's going to tell us is that's a very important level. So what you want to look for, you want to look to buy here, and that's why I draw that line. Is it always going to work out? Definitely not, but that's not the important thing. The important thing, if we want to try with the trend and we look to buy at fairly close to the lows, then we will on average risk much less than what we're looking to make. Why? Because I'm buying at the lower ends, and I know that if this is a genuine uptrend, then we're going to go up at least to the high, but most likely even higher. So that gives me a favorable setup where I would, in this case, look to risk about 50 pips and would look to make up to 100. The pips are the levels, the smallest increment that we can see here in price. It says 45.50, and if it goes from 45.50 to 51, then that's 1 pip. So we're looking to make about 100 pip here by risking 50. This is another example, but this is a downtrend. Why? Because the definition of a uptrend and a downtrend are symmetrical. So in this case, we had a rising uptrend to the upside, and we had a move to the upside. Eventually, it took out this low here, so things reversed, and you can see here that for 2 days, we're creating lower and lower highs and lower lows. When I look at this in the morning, I'm not going to start to buy, especially if I see that just in the previous hours, people have been selling. You're going to notice, and I'm going to talk about this later, that usually price makes up its mind in the early morning, and then it's going to continue to have that bias until New York starts trading. That's something we're going to talk about too. So here we can see a clear downtrend, and we want to sell. Here's another example. It's pretty much a continuation of what we're looking at here. We're trading here at 43.66, and we're looking for a drop pretty much to 43. We come down to 43, as we can see here on the chart, and at that point, we have an interesting observation. We can see that if we trade about 43.60, then at least the downtrend is still going to be down even from this level, because there are different degrees of downtrends. But on average, we can see here that if we go above this level, then we have about 40 to 50 pips to the upside with not much resistance. So this is another way of looking at this. It's the same thing pretty much. So you're plotting the highs and the lows that you can see on your chart. So you want to begin by doing so. You want to begin by taking a look at this to be able to know if we want to buy or sell. Do you have any questions on this?
What time frame is that chart?
Yeah, this is the 30-minute time frame. So on all of these, I load the 30-minute time frames. The reason for it is I want to see the details within the candlesticks. That's something we're not going to cover today, but there is some power by looking at how the candlesticks looks like. But on average, you load the 30-minute time frame, and you look for these, the major highs and the major lows. And as I said before, if we're trading up here and this is a genuine downtrend, then as a minimum, we need to reach that low and most likely even create a lower low. Okay, so that's the most basic, and it's probably one of the most powerful things I have seen. Something that we can apply to various markets. It's quite straightforward. We know when we're right, we know when we're wrong. There's really no second guessing here. It's just highs and lows, and using the markets and their trending characteristics. Okay, this is something different. This is probably something you have not seen before. This is something that I have not seen published. There is probably someone that had done this before, but I haven't seen it around. And this is really interesting. Why is this interesting? Well, I told one of my engineers, here's 5 years of data. You got data from 2007 to 2013. So you got 1,434 trading days. And I told him, I want to know at what time of the day we tend to have, in this case, lows and highs. So I asked him, when do we usually create highs and lows in regards to time? To the left here, we see the probability, and down here we see time. And we can clearly see here that at 6, 7, 8 o'clock, a majority of a low in a bullish trend are going to be created. So if you see that we create a low around that time, then most likely that's going to be the low of the day. How do we know this? Well, we looked at 5 years of data, and we can see here quite clearly that most lows are being created there. So if you want to pick the low of the day or have that momentum to your benefit, you need to look at the beginning. If you want to trade from the early morning, you need to look how price behaves in the early morning. And then if you do know that that's the low, that's great. You know why? Because if the market has moved with 30 pips, and on average it's going to move with an additional 100, then you definitely have risk-reward ratios to your favor. So you want to save this and remember here that we have a very high likelihood that a low is going to be created in the early morning. What else? Well, I asked him, so if we have a low in the beginning of the day, when can I start to short? When can I start to bet on this to go back? Or put it another way, if that is the low, when do I need to exit? When do I want to profit on my position here? When do I want to focus my attention to the markets? He said, sure, let's calculate that, and we did that. And we can clearly see on this chart here that around 3 p.m. GMT, 3 to 2 p.m. GMT, that's when most reversals kick in. So if you're having a bullish trend in the beginning of the day, don't try to go short at 9, at 10, at 11, 12, or 1 p.m., not even at 2 p.m. Don't bother with that. Why? Because this is what 5 years of data tells us. Is it always going to be right? Definitely not. But it clearly shows that up here, that's when most reversals tend to take place. So if you saw the market creating a low in the beginning of the day, then you want to keep it at least until noon, and then by 1 p.m. you can start to worry, should I exit or should I keep it? That's what this data is telling us. Unfortunately, we can't really see that there's like a major, we definitely see that at 5 p.m., then at that point, we can see that we definitely have a peak with 12%. And if you just aggregate this, 12 by 10, that's 22. And then you have another here at 4 o'clock. You can see here that we, with 32% probability, the distribution, we're going to land up here. And then if we accumulate this, you can see here that if you want to go long in an uptrend and you want to take on a position after work at 5 p.m., it's not going to be a benefit to you because at that point, we will most likely create a high in the uptrend. Same thing, but with a downtrend. So in essence, what we did is that we took 5 years of data. I told him, bullish days, bearish days. Give me the high, give me the low, give me the high, give me the low. It's same thing here. In a downtrend, so if you were looking at your charts, right? You're looking at your charts, and you saw that yesterday we were going lower, right? So we're in a downtrend. Overnight, we corrected some of these losses. And you see here that we're forming a high in the early morning. Then as you can see here, that between 6, 7, and 8, we're going to create that high in a downtrend. So that's when we want to be. If we want to do short-term trading, we want to be up early in the morning because that's when we tend to create most highs. And it's the same thing here as before, but here we can clearly see that there's that in the afternoon here, there's a very high tendency to create a high here at about 3 p.m. GMT. But the key thing is this: if we did create a high in the early morning, then at 9 or 11, it's way too early to be buying. You definitely want to wait until 12 to 1 p.m. here before you look to fade this move. And the reason for saying this is that most people, they tend to fade a move. They see a strong move, and then most people are going to look to, buy because it's cheap or sell because it's very expensive, instead of just going with the trend. And if you want to do that, then you really want to wait until the afternoon before looking to trade that. Okay, do we have any questions on that part?
Are these charts only for the euro, US dollar, or different currencies will have different charts?
Good question. It's for the euro dollar. It's for the euro dollar. But I would say if you're trading pound sterling, then it's they look very, very similar. They have a correlation about 80%. So pound sterling, yes. Aussie dollar is a little bit special because Aussie dollars is going to be traded in the overnight session. It's going to follow the same flow as the euro, but it's a little bit different. And I also haven't investigated the dollar yen, but the dollar yen is also another currency which is predominantly being traded when the Japanese market is open. So they have they should have, I haven't investigated myself, but they have a little bit of a different characteristics. But the cool thing with this, that's what I like at least, that I get numbers on things. When I get numbers on things, I can act on it. I already knew that we had these, that the market behaved like this. But if now I can say, well, there's a 40% likelihood that this low is gonna last, then it gives me at least some comfort to hold on to a position and remain being bullish throughout the day. Do we have any more questions on this?
Mostly European session?
Yeah, this is European session. Something here, I got a question about this material, and someone asked me, does it include reversals? No, it doesn't. So it doesn't include a reversal because, as I said before, on average, you'll see a currency go higher and higher and higher, but after 5 to 6 days, it's not going to continue to go higher. So one day it's going to break. So this data does not calculate reversals. We need to remember that. But on average, I think the key point here to remember is that in this case, if we look at this one, if you see a high being created at at 8 p.m., so you see the price was struggling for about 2 hours finding a high, and then we break off to the downside, then most likely that's going to be the high of the day.
Can you speculate as to why this is? I mean, at 7 or 8 in the morning, it's the UK opening, all the big banks making some moves in the afternoon, the US is opening, and
Yeah.
big players are doing something.
Yeah, I think in the early morning, exactly. Yeah, people come in, and then it's just going to be an aggregation of the demand and supply for that very day. When I was younger, I used to work for an investment bank, and it's quite straightforward. They call you in the early morning. It might be one of the big pharmaceuticals or car makers or someone that just needs a lot of money. And they say, okay, we are going to pay for a shipment from China, and we want to have 10 million euros. What's your price? And by the end of the day, if more people are buying, then this is going to push price one direction. And then I would guess that most of these highs have been created at 10 p.m. GMT. So I don't know if it's really like that, but I do know that then we have people in New York, and people start to call their trading desks, and people want to get into the market. So I suspect that it is that many of the major banks maybe will hold off to get a better price, because at this point liquidity is at its highest, because at that point New York and London is going to be open at the same time. So any major orders that you want to clear, you're going to clear them at that point because liquidity is going to be that high. So after that point, no one is really going to push price so much more. That's why you see it stabilizing, because at that point, all major trading has occurred.
You also have the London and New York fixes then.
Yeah, exactly. So you have the fixes. People will, due to liquidity, trade at that very point. because after that there's really no initiative to trade, because you would have cleared your largest order, so your book is safe overnight. Okay, all right, now we're going to look at something a little bit different. The chart looks very much like what we just looked at, but it's a little bit different because this doesn't really care about highs and lows. It just measures volatility. Whereas to your left you have the pip value, and here you have the time, and this is London hours. And you can clearly see here that when in our overnight session, the Asian session, volatility is going to be very, very low until about 5 a.m. in the morning. You're going to see here that volatility is going to be, 12 pips from high to low. So very, very, very tight volatility. And then we're going to have an increase of volatility where it almost doubles, hitting roughly 27 pips around 8 a.m. So you can clearly see here the markets are very tight in a narrow range, and then volatility increases. This volatility continues until about 12, 13, well, into the afternoon pretty much, and then we go back to the same type of behavior we saw earlier. Why am I showing you this? Why is this interesting? Well, it's interesting because we're looking now at the London range breakout. And the chart I just showed you what happens overnight, where the market is stable at one specific level. Not always, of course. Price can definitely move, can move up and down with, say, 25, 30 pips after and during the overnight session. But in most of the time, it's just going to represent a very, very, very small part of the range. And this is a very simple method. And it goes hand in hand with what I just showed you in regards to the highs and lows being created in the early morning. What we're doing here, we're pretty much adding a line to the top and a line under support here. And we're just trading a breakout. And remember what I said, the market is going to make up its mind in the early morning. So what you want to see, you want to put these lines here, pretty much boxing price in, and then you want to see price leaving this area with determination. You want to see a big candlestick like this one that is much bigger than the average of the other candlesticks. So clear determination that we want to leave this range, and we're leaving this going down. So this is the London range breakout. And what you only want to do, you want to put lines at resistance and lines at support here and just look for a breakout. Here's another example. It's not always going to be that clear. Most of the time it's going to be maybe a little bit messy. But here is another example. This is pound dollar. And we can see that we were trapped in this overnight range. At one point here, especially this big candlestick here, we decide to leave. You also look at your time of the day. You look at your time at the time, and the time says it's now 9 a.m. You know, after visiting this Barclays seminar, that after 9 a.m. most highs and lows are being created, right? So you would just look at your chart and you see, all right, okay, we're going lower. So most likely we'll continue to trade lower. So by doing this simple exercise, you can, with a higher likelihood, be able to determine what is going to be, in this case, the high of the session. Of course, there's a benefit if one would only trade situations that are in line with the big picture trend. But what I have seen, at least, that if this is a range, then most of the time, independently, if we're going up or down, we'll be able to get at least 1 to maybe up to 2 times that range. And that range will most of the time going to be maybe 15, 20 pips. And we can clearly see here, there is a tight range of about 15 pips. So on average, you will have a range of about 15 pips. And you can work with that to your benefit, because you have risk in 15. And if you manage to spot that high, then most likely we're going to do maybe 2 to 3 times that risk. Here's another example. And this is, of course, a little bit more far-fetched, but this is probably as good as the system can be. What we're looking at here is we're looking at the euro dollar, and this is nice downtrend we've been having here, which reversed not so long time ago. I'm just showing this to show you how you can combine the big picture with the smaller time frame. Whereas you can see here that price is trapped in a range, and what I did here is I took this is going to be our risk. So the range is going to be one risk unit, and the high and the low will be the risk in this case. And I just wanted to measure, and this is of course one of the better examples. You'll probably have this maybe once per week. It's not always going to be very good, but you can clearly see here that what I did, I just took these boxes, I created 4 equal boxes, and you can see here that in this case, if I'm just trading intraday, I would look to make 4 times that risk. Is it always going to be like that? Definitely not. But it just shows you the power of this and shows you the risk-reward ratio, where you look to make much more when you gain versus when you lose. Okay, so we covered the London range breakout. So for you to easier to determine the high and the low of the day. You can also use that to trade. What else? We covered the aspect of time, the price and time. Is there a relationship there? Yes, most highs and lows being created in the early morning, and then we have a reversal in the afternoon. We also, of course, covered what intraday trading is. Now I'm going to give you another tool, and this tool is not time dependent. It is price dependent, and it is the so-called pivot point levels. One of our other analysts at dailyfx.com took the pivot point indicator, and he calculated, does price respect these lines to begin with, and where does most highs and lows being created? I can tell you right now that by looking about pretty much 2,000 trading days, and it was, let's see here, how many? I think it was from 99 to 2006. We saw that on average, the high of the day is going to be around 1 pip above the R1 level, whereas the low of the day is going to be pretty much 1 pip under the so-called S level, S1. S stands for support, R stands for resistance. So on average, the high is going to be created around the R1 and the low is going to be created around the S1. So what is the pivot point indicator? Well, that black line here, that's the pivot point indicator. And it's pretty much the high from yesterday, the low from yesterday, and the close. And then they divide this by 3, and you get the average price from the prior day. Now, what they do afterwards is that they will pretty much add half of yesterday's range to the upside and half of yesterday's range to the downside. To calculate the R2 level, they pretty much take the whole range from yesterday. So that's the pivot point indicator. It's a very simple system, gives you the average from yesterday and the distance from that average plotted on this chart here. The key thing to remember is that with the help of data from January 1999 to October 2006, we got 2,026 trading days. The average low is going to be pretty much 1 pip on support 1, where the high is going to be on average 1 pip below resistance 1. Sure, yes?
Why did you take the data 99 to 06? Why not 07 through to 13?
This is an analysis that was created, I think it was created around 2006. So that's why.
So, and your previous data as well was up to 06, 99 to 06?
The other data was from 2000, let's see here, 2007 to 2013, with the highs and the lows. Usually when I look to do any type of statistical analysis, you should, as a minimum, look at least 30 observation days. So you want to have at least 30 days, and to be able to talk about if the likelihood of the parameters, if they're valid or not. And as more observations you add, you get a more stable relationship. So, yeah. What else? With the S2 and R2, as you can see here, only 16% of the time will we trade above these levels. So imagine that you're trading and you're looking to buy here because you can clearly see that we're in an uptrend. Well, if we are, say, between the R1 and R2, then you don't really want to buy because that's most likely going to be the high of the day. And if we are beyond the R2, then you definitely don't want to buy. Why? Because only 16% of the time are we going to be above that level. So you don't want to be buying where the high is most likely going to be created. Now, it's not me inventing this, it's just the way the market works. So this is just an indicator, and it's just an indicator, and this is what happened, you know. And it's the same thing with the S2. If we push under it, and then, you know, we're not going to continue to trade so much lower than that. So you don't want to be selling into that. One thing to remember, though, we want to trade with the trend. So there's definitely possibility to maybe sell here and look for maybe 20 pips decline or so. That's fine. But most of the time, you do not really want to sell into this. You want to just book the profit. You let price come down overnight. Say that we come up here, right? Then we come down a bit. You look for that London range breakout, and you would look to go long again the day afterwards. There's some simple systems that you can use. And this is the pivot point indicator. Now, there's a drawdown with this, and that is the breakout. Because it's based on the prior trading day, it's based on the average from yesterday and the range from yesterday. So if you have a very, very narrow range, and then you see a breakout, which is a pickup in volatility, then at that point, we'll most likely reach the R2 and sometimes even head a little bit lower. If you look at gold as an example, we had a very, very strong decline to the downside. Why? Because, well, I'm not going to say why, but we were tight in a very tight range, and then we had a strong breakout, right? So if you look at those pivot point levels for those specific days, I think it was 2 days in a row, price extended beyond those levels just because we were going from a low volatility to a high volatility market. Okay. So what have we done today? Well, we covered what intraday trading is. Most of you maybe knew this already to begin with, but it's pretty much buying at the beginning of the day and looking at the sell before the day finishes. Some people are going to look to buy the smaller increments, so they're going to look to maybe sell those 40 pips, and then they look to go long to make those 40 pips. You might remember this chart. Some people are going to look to buy all of those. Some people are going to look to maybe just identify that low and then look for the high. That's my preferred setup. Why? Because it's much more easy just to spot one low than looking to spot all of these small ones. Some people say, I don't care about that low and I don't care about the high, but I just want to know when this is going to be created because I want to have my 20 pips and then I want to stop trading. That's intraday trading. And then what else did we cover? We covered, with the help of the ATR, which is the average true range, the opportunities being offered here, whereas the short-term trader that's going to look to buy the low from the 4-hour and sell at the 4-hour high, he's going to look to make about 1,200 pips, where the trader is going to look to do intraday trading will at most get about 535 pips. And then the guy that looks to trade from a week perspective is looking to make 240 pips. We looked at that. What else did we look at? We looked at the overall trend and how we can use that. We looked at the 30-minute time frame, and I said if we've been going up for 2 days, then I dare to bet to you that we're going to go up for another move to the upside. Will it change? Of course it's going to change. It always changes. But if we've been going up for 2 days, then I'll bet you that we're going to go up for a third day too. What else? We looked at price and time. We know that there's a dependency between price and the highs and lows being created, where most highs and lows are being created in the morning, and then if it is an uptrend, then the high is going to be created in the afternoon. We also looked at the London range breakout, how you can pretty much box in volatility and box in price, and when you see price leaving that range with strong determination, either up or down, then that's most likely going to be the high and the low of that very day. And then we also looked at an alternative way of trading, which would be to use the pivot point indicator. So say that you are looking at price, right? You're looking at price, and it's pretty much between the R1 and the R2, so it's over here. And you look at time, and you see, okay, it's 2 p.m. in the afternoon. Then that's most likely going to be it, you know. You can definitely pop up higher with, say, 10, 20 pips, but you're going to spend an additional 5 hours for 10, 20 pips. So that's how we can combine the pivot point levels and time and pivot point levels and time. It's the same thing here. Well, you will see this sometimes. We're in an uptrend, but for some reason, you know, we're fairly close to the S1. You have the London range breakout. Then that adds up. So you will add all of this up to get a better feeling if we're going to go up and down. And that's pretty much what we covered today. Something that we haven't covered that I want to mention, and it's that a system like the one I just showed you, when volatility drops a lot, then at that point, any breakouts is going to be hard to trade. So that's something we need to be aware of. How do we know? Well, we only know it the hard way, unfortunately. Why? Because you traded one day and you created a loss, right? And then you traded a second day and you had another loss. And then most likely at the third and the fourth day, you're going to have a loss too if you continue to trade there. So if you see that you have a series of losses, then at that point, probably you're trapped in a low volatility environment. And what else? Well, trading psychology, sticking to the system, and that it takes time to accept risk. And how can we work around this? Well, I see trading as a numbers game. We have a small edge. We know when most highs and most lows are being created. We also know at which price level. We also know the direction. But I can look at markets, and I do analysis every day for people that visit dailyfx.com. And I know that it's a numbers game. I can't with 100% certainty say that today is going to be a winning day or tomorrow is going to be a losing day. But I know that if I play this every day, then in the long run, I'm going to be successful. And that also comes back to something that a lot of people are not aware of. But if you want to do short-term trading, then you need to remember that we're going to be right maybe 50, 60% of the time. At dailyfx.com, we looked at the 12 million real positions of about 100,000 clients. And of these 100,000 clients, on average, they will be right about 60% of the time. So we need to remember that it's not going to be easy every day. You definitely can have losing streaks. It's like everything else, you know. If you are a professional sportsman, you're not going to be winning every tournament, right? You're going to have maybe a couple of months of hard training, and then you come out and you do really, really good. And you need to capitalize on when it goes good. And the fact that we're only going to be right about 50% of the time, how can we use this to our advantage? Well, how do we want to trade? Well, before taking on a position, you want to look to make at least 2 times the risk. And that's why I showed you that trend following system. Why? Because if we buy at a decent level, we risk 50 pips. But if it goes good, we're going to make about 100, right? So you want to have that risk-reward ratio. And that's also the number one reason why I show you that risk, the London range breakout. Because if we do create a high in the beginning of the day, then most likely that's going to continue to be, well, most likely if that is the high, you risk 15 or 20 pips, and it continues lower with the average volatility of about 100, then you're once again putting the odds to your favor. And then another important aspect of money management here, and it is very simple. If you risk too little, you are going to win a little. But if you risk too much, you will eventually run to ruin. And if you are doing short-term trading, if you think about it, I wrote here 1% of your capital per day. But imagine that you're doing really, really well. So you risk 1% one day. You lose 1% the first day. The second day, you had a winning trade. And because you applied good risk-reward ratios, you made 2% back. Then on the third day, you had another winning gain. So at that point, you're up with pretty much 3%. and that continues with maybe a loss on the fourth day, and then maybe a gain on Friday. So you might look at this and say, well, 1% of my money is not a lot of money. But if you do this consistently, then as you can probably calculate yourself, we're talking about quite high returns by the end of the year if you're just risking more than 1%, risking less than 1% of your money on any given day. And why am I even mentioning this? Well, because many people, they're going to open up with an account, and then they're going to bet 10% of that account on one single move. Now, it's fine to do so, you know. We have people that has, you know, done 300% on competitions and short-term traders and short-term trading. I mean, in short-term trading. I know myself people that have done amazing results, but I also know that it's really hard to keep those gains. We also know that people that have big accounts and trades with less risk tend to be more profitable than short-term traders. We know that because we have clients in, with dailyfx.com, we have clients in Hong Kong where the maximum leverage is about 50%, and the average Hong Kong trader will usually be more profitable in jurisdiction where people have 200 times up to 400 times leverage, just because they're not using the leverage too risky, with too much leverage. Before we finish, we're going to talk a little bit more about money management, but I just want to ask you a simple question here. Does anyone know here how much Warren Buffett usually does as a return on a yearly basis? Warren Buffett, you know, the second richest person in the world. Since he started up with his investment company, a majority of his wealth is tied to the share of that company. Do you know how much he does in return?
High 20s?
Yeah, 22%. So if a trader with a decent amount of capital would look to maybe do 22% per year and do that for a long amount of time, then by the end of the day, you know, it wouldn't be surprising if that trader would be able to come close to Warren Buffett. Just an example. That's just a simple example on how you can, how I would suggest that low leverage is a better way going forward. Okay.
I'd ask you to make a comment about the time, 8 o'clock or
Yeah.
10 o'clock in the evening, when you often get a close slightly higher. Why that occurs?
Can you repeat the question?
There's often a closing of markets, the American market,
Yeah.
around that time, 9 o'clock. So you can do something often between 8 and 10 o'clock at night.
Yeah.
Could you comment on that, to avoid it or not to avoid it?
Yeah. Yeah.
Why it occurs?
Usually in the afternoon, I mean, there's the gentleman asking here, if I understand it correctly, trading after the New York close?
Yeah.
Yeah. After the New York close, volatility will drop a lot, and it's actually where most people tend to do the best, just because it's low volatility. So at that point of the day, it's definitely interesting to trade, but you will look to trade with range-bound strategies. So you would look to buy and sell close to the highs. And a very interesting thing with this is that at that point, respect to support and resistance tends to come back to the market. On average, if we look back at something like this, so if we're coming lower here, it's not going to necessarily respect that low over here. So anything that is limiting the trend, price is not going to have any respect for that as the London session plays out. However, in the afternoon, price suddenly regains respect for support and resistance, and there's a lot of people that would look to buy for a swing position. So they would look to buy, and then they would look for a move back to neutral levels throughout the night. So if you want to trade the Asian session, you want to trade range-bound strategies, and you can also, with higher confidence, says that support and resistance that you see on the chart is going to be respected. That could be one way of trading.
Welcome back. Just like to thank Alejandro for his first presentation this morning. I hope you all agreed it was very thought-provoking. But in my time at foreign exchange, the only reason it went up is because there was more buyers and sellers. But technology is what it is. So thank you, Rashidi, for coming back. Our second presentation is by Petter, is our currency expert at Barclays. He will obviously go through the FX outlook on a great rotation. Thank you, Rashidi.
Great, thank you, Peter, and very good morning. So introduce to myself, my name is Petr Krpata. I am an FX strategist at Barclays Wealth and Investment Management. And today what I would like to do is to share with you our thoughts on the currency market and where we see the next big thing and where we see the opportunities within the FX. And by doing so, I will argue and that things are changing. I will go against the conventional wisdom. I will go beyond the obvious, and I will argue that the dollar, the US dollar, is no longer the currency we all were used to see and we used to know. The dollar, in our view, is changing. The pattern of the dollar is changing, and the dollar will become a procyclical currency again, as it was in the past. And also, the second theme I would like to touch upon is a great rotation, hence the name of the presentation. Many investors today are talking about the great rotation from fixed income into equities. To us, this is fundamentally reasonable story. But when investors today are focusing on the great rotation between these two asset classes, they are forgetting one thing. There's already one great rotation underway. And where it is in FX markets. The correlations are changing. Currencies no longer trade in blocks. They don't no longer trade in risk-on, risk-off fashion. And now there is a further room for differentiation, for alpha, rather than beta. In terms of contents today, again, I will touch on that big thing of the great rotation. I will also talk about the US dollar. As you can see here, the name the sentence I put there is the welcome the new US dollar, because indeed there'll be a time for the new US dollar. Then I will also touch on the euro outlook. In terms of the euro, we are bearish, but we don't expect a collapse of the currency. Rather, we expect a gradual softness. And the reason being is that we think that the ECB, via its outright monetary transaction program, put a backstop facility in place, and the euro will weaken based on its unfavorable fundamentals rather than a risk premium. I will also, of course, because we are in the UK, I will touch on sterling, and I call that part of the presentation, Sterling Outlook, racing to the bottom. We have seen sterling in the first 2.5 months of this year. The currency was just beaten big time. The question now is whether this race to the bottom is over or whether there's a further room for sterling weakness. We think that most of the weekend is over, most of the sterling weakness is over, but particularly against the dollar, we see a room for some modest weakness of sterling later in the year. And finally, because I'm FX strategist, there's no way I can do a presentation right now without touching upon the Japanese yen. The Japanese yen was in the headlines. Big thing is now happening in Japan. The currency is also changing its properties, and we think that the Japanese yen will trade soft over the next few months and quarters, and has a scope to replace the dollar as a funding currency of choice. So this is the summary, but let me now talk about the thing, about my initial remarks. A great rotation underway in FX markets. And just to summarize this, first, the theme of the US dollar. Look at the US dollar here at this slide. This is a dollar-euro correlations with risk. With risk, I mean equities markets, and I gauge risk by the MSCI World Equity Index, which sort of gives you a sense of the global theme of risk. What you see there, that since 2008, dollar's correlations with risk absolutely fell down, is highly negative, and hence we have seen this theme of a dollar doing only well during the risk of environment, and dollar weakening when things are well. But we think that we have already bottomed out this theme. We think that we now see a correction underway, and we think that this blue line will move further up, and the dollar will have a scope to benefit from rising markets. And I will talk about it later, why. Why exactly we think that the dollar can do well in rising markets. The second point here about the growth rotation is G10 currencies as a whole. You can see here correlations of G10 currencies against the dollar. The blue chart is the correlations with risk from 2009 until 2012. The black bar is in 2013. What you can see everywhere, apart from the Swiss franc for these specific reasons of the floor under the Euro Swissy, you can see that the correlations are normalizing. In terms of the historically high beta currencies, Canada, New Zealand, Australia, Norwegian krona, Swedish krona, all the correlations with risk normalized, and they fell by more than 30%. Again, this is telling you there's a shift underway. We don't think that in the future or over the quarters ahead, when markets will be rising, these high beta currencies will go up, and on the other hand, dollar, yen, or Swiss franc will go down. We think that investors will now start to differentiate. This chart on your left-hand side tells you the same thing, but in trade-weighted terms. Because obviously, one thing is to measure currencies against the dollar. The other thing is to measure currencies' behavior against their largest trading partners. And you can see there very similar shift. And this chart on your right-hand side is extremely interesting, and again gives you an evidence of something I just talked about. Look at this is a year-to-date performance of currencies against the dollar over here. And this is a year-to-date performance of MSCI World, the equity index. See how much the MSCI World is up year-to-date. In the old world, in the world of risk on, risk off, in the world of currencies trading in blocks, Canada, New Zealand, Australia, Stocky Noki would be up. It would be up in line, almost in line with the MSCI World. But what we see so far we see big differentiation. You can see, because this is measured all against the dollar, if these currencies are down, by definition, dollar is up. And only the New Zealand dollar managed to outperform other high beta currencies, and actually is up against the dollar year to date. Again, to us, this is another evidence that big things are happening, patterns are changing, and investors who trade FX today must be aware of that, because if you want to make money, you have to be aware that it won't be the simple risk on risk of trade of the past years. You have to start looking for alpha. You have to start differentiating. Okay, so dollar. Welcome the new US dollar. I said beforehand that we expect the dollar to become procyclical, one of the big themes in the Great Rotation argument. Why the dollar should become procyclical? Let's have a look in the past. By the way, today or a few months ago when I was presenting this idea to clients and investors, sometimes they look at me and ask me, dollar procyclical? Dollar doing well in rising markets? How come? Come on, dollar is a risk of currency. Dollar only does well when markets are falling. When markets are rising, people go out of the dollar and they use the dollar as a funding currency to go somewhere else. Yes, that was the true. But that was the true over the past years. If you look back at 1990s and early 2000, dollar was in fact a procyclical currency. In that time, and people forget this, in that time the US dollar did well in rising markets. When the US data were good, dollar went up. When they were bad, dollar went down. Why was that? In that time, late 1990s, early 2000, as you can see here, period of procyclical US behavior. Why? Because in that time, US economy was far stronger than its peers. What I've done here on this chart, I calculated real GDP growth differential. What I did there is I took real GDP growth in the US in that time, and from that I subtracted the real GDP growth of its major peers. Euro area, UK, Japan, and of course, rest of the world. And what you can see here in this box is that the dollar in that time outperformed in terms of growth other major countries. Hence, it did well in rising markets, because if you have a higher growth, by definition it means most likely more favorable monetary policy in terms of effects. It means tighter monetary policy, hawkish bias of the central bank, and also by definition, higher growth means better investment opportunities. And these are these two things, monetary channel and asset price channel. So if in the past the dollar was procyclical when the US outgrown its peers, let's have a look at our forecasts. Do we expect US to outgrow its peers? Do we expect them to beat them? Yes, we do. You can see here, gray bar is the US, black bar UK, blue bar Euro area. This is quarterly annualized real GDP growth. Q1, Q2, Q3, Q4 this year. In all cases, you can see US comfortably beats its major peers in terms of FX trading, cable and the euro dollar. Why is that? Again, as I mentioned out, good or strong US economy and US economic outperformance will benefit the dollar via two channels. Monetary channel, asset price channel. In terms of a monetary channel, i.e. what does central bank does? What does central bank do? We think that from now on, and after this massive periods of easy monetary policy, of Q1, quantitative easing 1, quantitative easing 2, quantitative easing 3, reinvesting proceeds from maturing securities and obviously low rates, we think at the moment things are changing. Because if you look at the real data, US unemployment is falling. Last quarter, the data surprised massively on the upside. And inflation is sort of where it is. When the Fed adopted the Federal Reserve, which is the US Central Bank, when they adopted the sort of the data target and are targeting 6.5% unemployment, of course, unemployment is still above 7%. But the point is where it is going to go to. We think it will be falling. And remember, markets are forward-looking. Markets don't trade based on what is the data right now. Markets are trading on patterns, on views, and on forward-looking things. And we think that if the US unemployment starts falling, markets will not ask a question in terms of the Federal Reserve. Is there going to be more QE? Are they going to print more money? That's not the case. Even right now, the question the market is asking is when the Fed start normalizing its monetary policy. When the Fed will temper the asset purchases. The question is whether it will be later this year or early next. I don't want to be too concerned about the exact date, but the pattern there, or the question there, is when the policy will be normalized, when it will be tightened. In contrast, in the euro area, the question is, what the ECB do next? Will it cut interest rates? Will it do some form of QE? We don't think. In terms of the Bank of England, the same thing. Is there another round of QE underway when Mark Carney takes office in summer? And of course, in terms of Japan, we all know what happened there. So in terms of this monetary channel, we think that good US growth will positively affect market expectations of the future monetary policy. And of course, if market starts expecting normalization of the monetary policy, US yields will rise, and historically, currencies also trade on the yield differentials. This should benefit the dollar. Second point is asset price channel. As I said, growing economy should affect currency in a positive way, because if you grow faster and more robustly than your peers, it should mean that investment opportunities within your country are more attractive. And we've already seen it on the US real estate, which has normalized, the prices normalized there and they are rising. And we also see it on the US equity markets. S&P 500 is doing really, really well. And it does so because the US economy has stabilized, the US consumer is resilient, and by definition, the companies there should do well. Hence, rise in the S&P. And of course, what does it mean in terms of currencies? Better investment prospects within one country should mean less of outflows and more of inflows. Again, this should be positive for the currency, so the asset price channel. Important conclusion of this is that if you think that in the US the monetary policy will move in favor of the dollar, and you think or assume that when the US will outgrow the other economies and investment opportunities will be attractive over there, the dollar should no longer be seen as a funding currency. Again, if we look at the past years, why did it underperform during the periods of rising markets? Because at least in terms of effects, when you went to the emerging markets or cyclical currencies within G10 like Australian dollar or New Zealand dollar, what you did, you funded the long positions there via the US dollar. Why would you do it now when the future monetary prospects for the US look more favorable than its peers and when things are better there than compared to its peers? We think that the dollar, because of that, will lose the status of a funding currency of choice, and it will be replaced by euro, Japanese yen, and also Swiss franc. Again, if this will happen, the selling pressure on the dollar during the good times will ease, and the dollar will do well. And of course, in terms of a long-term valuation, what I show here, this is a purchasing power parity. This is a really long-term valuation matrix, 5 to 7 years. Over this time period, currencies should revert to its fair value. I took the PPP, purchasing power parity, from the OECD, and what I show here is the misvaluation of currencies. Everywhere, in all the cases, dollar is cheap versus the G10 peers. So, at least from the valuation perspective, the future for the dollar should not be constrained. So again, to summarize, big things are happening with the dollar, and because of the US economy outperformance, we think that the monetary channel, i.e. the outlook for the Fed, and asset price channel, i.e. investment opportunities, will benefit the dollar. The dollar will lose the status of a funding currency, will be replaced by others, and dollar will be the strongest currency amongst the majors. We think the dollar will appreciate against the yen over the next few quarters, against sterling, and also against the euro. But what about the euro? I wrote here gradual softness rather than collapse. And I talked about it beforehand. Last year, 2 years ago, 3 years ago, people were so scared. They were so concerned about the euro and they expected a collapse. Why? Of course, because of the euro risk premium, what was happening in peripheral countries, and the uncertainty about the European breakup risk. But one thing has changed. Last summer, in the famous speech of President Draghi here in London, he basically pointed out that the euro will stay intact and the ECB will do all it can within its mandate to keep the currency together. This was first thing. Second thing, a follow-up from the ECB, was the introduction of the outright monetary transaction program. A big thing, a game changer for the euro. What happened there is that the ECB said, okay, if there are countries in need, in periphery, and need our help in terms of stabilizing their bond market, we will buy these bonds. It has never been activated. But just the idea that it is there, the idea of this backstop, has kept euro resilient. And I think a case in point is last few months. Early in the year, we had the Italian elections with inconclusive outcome. A few weeks back, we had the Cyprus crisis. During this time, I would think that if this happened last year, 2 years ago, the euro would fall down. It didn't. This is a euro trade weighted index, yeah, slightly up, but no massive fall, and now, slightly down, but it wasn't a massive fall. It's up again. What is more, the financial conditions in the euro area remained resilient. By what I mean by financial conditions. This is the black line is the Euro Stoxx 50, European equity market. The blue line is Italian 10-year yield, reversed. This is the period of the latest jitters. Not a big thing if you compare it to this period. So the OMT, the Outright Monetary Transaction Program from the ECB, has been a game changer and stabilized the euro. So we think that the risk premium, the concerns about the breakup risk, will not be the main driver of the euro. But what will be the driver of the euro is the fundamentals. We think that the euro will weaken both against the dollar and sterling because of its comparably worse fundamentals. Because at the end of the day, I don't want to pretend that the US economy is in amazing shape. It isn't, and growth, our economists expect US to grow around 2% this year, is not great by historical standards. But we all have to remember that currencies is a relative value trade. When you buy a currency, you always sell another. You are trading currencies in a cross. Hence, this comparison or this comparative analytics is very important in terms of currencies. And we think that the euro, in terms of growth, will underperform. This is annualized growth for the euro area for this year, Q1, Q2, Q3, Q4. Yes, it is picking up, but still, it is picking up from low levels, and there are still downside risks. We know that although Germany is likely to do well, others in the periphery, Spain or Italy, are not likely to do extremely well, precisely because of the austerity measures and normalization there. Again, we don't think it will be collapse. We think that they will gradually recover, but currencies are about relative value. And from the economics point of view, dollar or the US economic prospects looks stronger. Also, the other thing people forget when they are talking about the euro is that the euro is a sum of parts. It consists of many countries, unlike the US, unlike the UK. And what we have seen last year is that rather than euro trading on the headline numbers of the whole euro area, whether the economy is growing by 2% or 0, or whether there is a current account surplus overall or current account deficit overall, this is not the case. Euro is trading based on the divergences among the countries, based on the differences. And I use this graph to show this. This is a current account. I always hear that the euro should do well because unlike the US, unlike the UK, the euro area as a whole has a current account surplus. What does it mean? If you have a current account surplus, there's more of inflows than outflows, just by definition. So there is this natural buying pressure of the currency. Yes, but in the same time, look at the divergences. This is Germany, this is Ireland. But this is Spain, Italy, Portugal, and Greece. This euro area whole current account number, it masks the divergences. And even though, as I said before, we don't think that the euro risk premium or concerns about the existence of the euro will drive the currency, still, some of these concerns will remain there. They will not be the main driver. But again, people or investors will always be concerned about these divergences. And this is another thing why we think that the euro is unlikely to recover on a sustained basis. So overall, what all this means, weak economy, divergences among countries, and of course problems in the periphery, all this means that the ECB, the European Central Bank, will have to remain accommodative. Unlike the Fed, as I said before, market is not asking a question when the ECB will normalize the monetary policy. The market is asking a question, what will be the next step in terms of easing. In terms of data this week, tomorrow's Euro area PMIs and Wednesday's German IFO index will be important to gauge whether the ECB will cut interest rates next month. If these surprise on the downside, they may. Again, is it going to put a massive downward pressure on the euro? I don't think so, because the interbank rates in the euro area are already so low and are already close to zero that the rate cut won't have a massive game-changing impact. But what it will do is that it will confirm the trend of monetary divergence between the US and the euro area. Loose monetary policy in the euro area, potential for normalization in the US. Hence, this should be beneficial for the dollar against the euro. Here, I just showed our forecast. We expect euro to fall to precisely 123 in 12 months, and 6 months is 125. So if I was a trader with a 6 to 12 month view, I would use any rebounds in the euro dollar over the next few weeks or potentially months, if there is any, to 133, 34, 35 to establish medium term 6 to 12 month short position of the euro against the dollar. Then sterling, of course. We are in the UK, so I guess this is a currency we all are interested in. The race to the bottom, as I pointed out, I've chosen this name because sterling was indeed racing to the bottom, and the race was against the yen early this year. In one point of time, sterling was almost as weak as the yen in terms of the year-to-date performance. Of course, then it slightly recovered. Yen continued falling, but still, in terms of the year-to-date performance, sterling is the second weakest currency in G10 FX space. Is it justified? Yes, it is. No wonder that the currency collapsed because of this massive cocktail of negative news. If you think about it, data were extremely weak. What does it mean? Weak economic prospects. MPC, Monetary Policy Committee of the Bank of England, ultra dovish. Normally, this would be understandable, but when you have a so ultra dovish Monetary Policy Committee, and in the same time you have stubbornly high inflation, which is expected to be even higher than, say, expectations 1 quarter ago, this doesn't bode well for the currency. You add to it the uncertainty about the impact of the incoming governor, Mark Carney, and his impact on the monetary policy, whether he will try to make it more dovish. You had the fading safe haven demand for sterling, because to me, or to us, sterling was artificially supported last year during the euro area crisis, obviously because in that time, AAA rating, liquid sterling, liquid currency, deep bond market. No wonder that some of the flows out of the euro area ended up in the UK, in UK assets. But this has reversed, hence the collapse. You add to it the latest 2 UK downgrades, mainly the first one, and also Mr. Cameron's promise of an in-and-out referendum about the EU. Yeah. I mean, it's understandable that sterling ended up where it was. But that was the past. Our main interest is where's the future. We think that the most of this bad news is already in the price. To be fair, like everyone knows how the UK economy is weak, how the MPC is dovish, and that, I mean, by definition of that, it is extremely hard to surprise on the downside. Also, in our view, sterling already by and large adjusted to this artificial support it got last year when it benefited from the safe haven flows out of the euro area. This could be seen on this graph. What I've shown here is this is sterling against the euro, the black line, and the blue line is the Italian and Spanish 5-year CDS spreads over Germany. This is important here. You can see as these CDS spreads were falling, it wasn't reflected in the sterling. Suddenly, then, early this year, sterling collapsed. And now, just by eyeballing we can see is that that sterling against the euro is trading by and large in line with this gauge for this safe haven premium demand from the euro area. Also, against the dollar, sterling in terms of the long-term valuation matrix is now closer to its fair value. Hence, limited room for further collapse. I would also say one thing, because I often hear this argument that yes, sterling has weakened, but it will weaken even more because the UK authorities will use the currency as a tool to prompt up the economy to get out of the recession. And I don't find this argument very plausible, because if you think about it, sterling in trade-weighted terms collapsed by 25% in 2008-9, in late 2008, after the Lehman Brothers, of course, because of the UK economy being exposed to the banking system and also the real estate. But even this 25% fall in sterling, which is on the left-hand side on the graph, didn't materially affect exports. You had a cheaper sterling. Did you export your way out? You didn't. Because it's not about the currency, it's also about your trading partners. If you think that the euro area is your largest trading partner, no wonder that the weak currency doesn't help so much to the UK economy, because the euro area, in terms of the economic outlooks, is in even worse situation than the UK. Both in present times, also we think in terms of the future. So we don't think that the weaker sterling will be used as a tool by the authorities to prompt up the economy, because it didn't work in the past. And still, unless the euro area recover, it's hard to see sterling or weak sterling to help the economy. So overall, we think that the sterling weakness was justified. No wonder that the currency collapsed. We think that the currency will stabilize now against the dollar. Against the dollar, my view is that it will trade in a range 150, 154 over the next few weeks or months, precisely because too much bad news is already priced into the currency. Hence, it should limit its downside. And also, although we are bullish on the dollar, and we think that the dollar will become a new currency, new procyclical currency, we think this will happen later in the years, in the second half of the year. Right now, the dollar, we think, will pause for a breath, because precisely the data surprised so much in Q1 that now it is much more difficult to surprise on the upside. And also in terms of the US economy, we can see first effects of the sequester budget cuts on domestic demand. So sterling or cable for now, range trade, but then later in the year to weaken a bit, not a collapse, but a weaken a bit, because basically US fundamentals looks much more favorable. So what I would do, if again I am a longer term investor, I would use any sterling strength above 154 to establish medium-term short position against the dollar. Against the euro, we think that the currency will not go anywhere, because prospects both in the UK and the euro area are not great. But still on the margin, euro area prospects looks worse, and hence we expect sterling slightly to appreciate against the euro by the year end, and our forecast currently pencils in euro sterling at 0.83 in 12 months. But where I would see potential opportunities for long positions for sterling is against the Swiss franc. Swiss franc is our favorite chart. We think because of the floor under the euro Swissy, because of the deflation concerns, and because Swiss franc almost trading like the euro right now, with further potential weakness, we think this could be interesting long-term trade. And also, Swiss franc is one of the most overvalued currencies in the G10 space. So very long, like 2-year-long positions in terms like being long sterling, short Swiss franc could be also very interesting trade. And finally, the yen and the yen outlooks, and again, words turning into actions. There is a big change happening also in Japan. The new government under Mr. Abe has changed the state of affairs in Japan materially. They have came with the target that they will want to take the Japan out of the deflation, and then will want to make Japan growth again. What did they do? They have nominated and elected a pretty dovish Bank of Japan board. And I think the latest or the last Bank of Japan meeting showed us a point in case. What Japan did was pretty aggressive. These guys, they announced that in order to reach this 2% inflation target, they will double Japanese monetary base over the 2 years. They will increase the monthly purchases of Japanese government bonds from 4 to 7 trillion yen. They will also extend the maturity of these purchases. What all this means? In 2 years' time, Japanese Bank of Japan's balance sheet will increase from 30% of GDP currently to 60%. It will almost double. This is unprecedented. Yes, of course, most of it is now priced into the yen. Of course, market is forward-looking. Market is already aware of that. So if you are trading a dollar yen, I think that most of the party is now over. But still, I would use any Japanese yen rebounds, which I think will be temporary, to establish long dollar position against the yen. We have seen such a rebound. I think it was 1 or 2 weeks back when the yen, like in a day, fell from or appreciated against the dollar from 98 to 96. If you use such rebounds to establish long-term positions, you can make few percent on this trade there. But again, are we going to see another 20% fall in the yen in 2 quarters? I don't think so, precisely because this is by and large priced in. But still, we think that the yen will trade on the weak side, precisely because of this ultra-dovish monetary policy and also its effect on the Japanese investors' behavior. Because one interesting thing about the yen is that although the Japanese yields were close to zero over the past years, and yields almost everywhere were higher, because of the deflation in Japan, i.e. negative inflation, the real yields, which is the nominal yield minus inflation, were in fact positive. By the way, this is a current real yield, or this is a real interest rates in Japan. It's the interest rates minus inflation there, positive. We all know that interest rates in the UK or in the euro area are higher in Japan. But look what will happen when you account for inflation. The real yields are negative. And we think that this past attribute, that even though the yields were low, but inflation even lower, so real yields were positive, this made Japanese yen pretty strong in the past. But what will happen now? If the Bank of Japan will reach its 2% target, inflation will go to 2%, nominal yields will stay where they are or get even lower in Japan, this blue bar will move here. So Japanese households, Japanese investors will face again, or will face, as in other countries, negative real yields. What they are going to do? They will probably look for alternative elsewhere. They will look for fixed income alternatives elsewhere. So what does this mean? There will be, most likely, there will be some outflows from the yen, and this again should keep the currency on a downside pressure. You also add to it that the Japanese life insurance companies and pension funds are hedging their foreign investments exposures. If they start to believe that the yen is likely to weaken, and if the yields in the US will rise, they may adjust their hedge ratio slower, and again, this should put some downward pressure on the yen. So overall, we think that the yen has further scope to weaken against the dollar. Our 6-month forecast is 103. And we think that the yen, because of what is happening there, has a scope to replace the US dollar as a funding currency of choice. And then also we think that the euro will do the same, also will become a funding currency of choice. And hence, we think that the yen will underperform the dollar, euro will underperform the dollar, and sterling will underperform the dollar. By the way, these are our current forecasts. And I think that from my side, that would be it. Maybe just to summarize, we think a great rotation in FX markets is underway. Investors should get used to a pro-cyclical US dollar. Investors should get used to differentiation. Currencies will no longer trade in blocks as they did in the past. We think that this period of risk off, risk on environment is over. And people or investors should think twice about where to put their FX longs, because things or FX will not trade as they have done in the past. So that it's all from me, and I would be very happy to take some questions. Yes?
Very simple question. World interest rates, what's your outlook for that, very briefly?
Where? In
World interest
world, we think that Japan obviously zero, UK zero over the next year or two. Euro area also, there's no, basically they cannot rise interest rates precisely because of what's happening in the peripheral countries. And in the US, we also don't think that the interest rates rise is on the table right now, but there, the view the bullish view on the dollar is based on the fact that the policy will start normalizing there. First, they will scale down the QE, and once the QE is scaled down, then market will start expecting rise in interest rates. But is it going to happen this year or next? Probably not. Definitely not this year. Next year, most likely not too. So low yielding environment. So again, this should be broadly positive for assets classes like equities. Yes?
Yeah, I'm interested in your sterling Swissy analogy. What sort of points will you buy into where sterling could go as low as Swissy before you start buying into to come back up again? We saw a low of 140.70 last week.
Yes, and currently, so it was like 142 or something. Our 1 year forecast is 152. And there again, to me, the best way how to think about the sterling Swissy is to think about, because it is by the end of the day, it is a sum of two things. It is a sterling euro and euro Swissy. Euro Swissy to us is now low. So from the Swiss part of the equation, it's attractive because Swiss franc cannot appreciate more against the euro if the floor is credible, because it's now 120, 1.56 or something like this. So again, no room for upside. And in terms of the euro, I think that the euro could be a marginal beneficiary also of what happened in Japan, because this monetary easing and funds or Japanese funds looking for alternatives abroad can also in part benefit the euro now, because, for example, peripheral assets like Spanish or Italian bonds still offer attractive yields. What is more, both in nominal and real terms, because the inflation in the euro area is low. Also, what is important there, and as we discussed previously, these assets were relatively resilient over the past few weeks or months, despite the Cyprus situation and despite the uncertainty after the parliamentary elections in Italy. So from that perspective, this should give probably the Japanese investors assurance that these assets are sort of, in a sense, slightly less risky than they were in the past. It can attract some of the flows into the euro area, or into the euro. Is it going to last forever? No. So I would use any rebound there to establish the long positions. And in terms of a sterling Swissy, I would be probably buying below 140.
Would you grade into it? Would you look for the lower and buy more and more as it goes down?
Again, to be fair, it depends on your risk budgeting and everything. But yeah, I think to be fair, this is probably the safest way how to play this, because although these outlooks and which I presented there are all well and good, sometimes there is could be massive unexpected events and you can find yourself missing the boat. So I would agree. This could be interesting way how to play that in terms of positioning and timing. Yes?
Could you comment on the Chinese
Yes. On
We have some kind of currency convergence here, a big pattern,
Yeah.
where currencies all come closer. If something happens with China, would this interrupt this?
if something happens to China in terms of economics outlook,
Yes.
and you would have this hard landing people talked about, which we don't think is happening. It's rather soft landing or L-shaped recovery that fall and now gradual growth. Of course, it wouldn't be good for the risk assets. It wouldn't because China, because Chinese outlook is extremely important to gauge where equities goes and of course how currencies trade. I think that the dollar would benefit just purely from the fact that it would increase haven demand for that. Cyclical currencies would be under pressure, mainly Australian dollar, which obviously has been in the past a good gauge or good proxy for Chinese growth because of the nature of its exports to China. But of course, it wouldn't be a good thing for us. But our base case is that there will be L-shaped recovery. Chinese economy will grow around 7 to 8%, and with that, renminbi will continue gradually appreciating. But in terms of renminbi, what I would say is that when we do our forecast or where we think about the future path of the renminbi, it is a managed currency. So by and large, your view on the Chinese currency is what will Chinese authorities allow it to do. And we think that the renminbi will be on ongoing appreciation trend because one of the goals of the Chinese authorities is to rebalance the economy from exports and investments towards consumption. And renminbi, stronger currency, is one way how to help to achieve that. Also, what I would say there is that in terms of valuation, whether the renminbi is fairly valued or not, I still hear this argument that the renminbi is like massively undervalued and should appreciate only because of the valuation. And we in Barclays, we absolutely disagree with that. Renminbi is almost fairly valued. And if you think about it, how the renminbi behaved over the last years, 5-6 years, it was on a constant appreciation trend. If you look at the other, precisely it was on a constant appreciation trend, precisely because it is a managed currency, and it was allowed to appreciate. And also during the times of the worst risk on environment, during the periods of Lehman Brothers, it was just fixed to the dollar, so it didn't appreciate. If you compare renminbi to other emerging market currencies, or to most of the emerging market currencies, you will find that over this time period, renminbi is much stronger than the rest. Also, from the valuation perspective, if you value currencies over the long term, you also look at the relative inflation growth, and there, just by a simple calculations, you find that because inflation in China was much higher over that time than in the US, so in a sense, fair value of the renminbi went down. So I would say renminbi ongoing appreciation trend because they want to rebalance the economy. The currency will no longer be the one-way bet it used to be. Now it is more allowed to trade based on the demand or market demand and supply, but still it trades within a band. But we think it will appreciate because Chinese authorities will allow to do so. But we don't think that the currency is necessarily cheap. It isn't. Does that answer your question? Thank you. Any other questions?
You mentioned the Australian dollar.
Yes.
And I noticed on your previous slide you saw that depreciating
Yeah.
against the dollar by 5.7%.
Yes.
Could you just comment
Sure.
on that?
What I think that long-term Australian dollar is massively exposed to a big weakness. Because fundamentally, Australian dollar is not in a good position. From a valuation perspective, the currency is extremely expensive. I refer back to that valuation slide. This is the PPP fair value measure, and this is by how much is based on PPE from OECD. How much is Australian dollar overvalued against the US dollar? It's like 50-60%. Again, one has to take these valuation matrices with a pinch of salt, but still, it shows you something. Second is in terms of fundamentals. When you think about Australia, Australia has been running a persistent current account deficit over the past years. And to me, this is extremely surprising because Australia was benefiting from this Chinese growth story. It was exporting its commodities to China. Yet, this country managed to run ongoing current account deficit. Obviously, if you run a current account deficit, you have to finance it. And because they had to borrow from abroad, Australia, after New Zealand, has the second highest net foreign liabilities in the G10 FX space as percentage of its GDP. Another reason why one shouldn't be particularly upbeat on the long-term prospects. Also, there could be, one can also argue that Australia can suffer from this concept of Dutch disease, whereby it sort of, because it has been exporting commodities to abroad and mainly focus on this industry, it basically, it shied away from other industries within Australia, and hence its productivity could have been impaired. So what I would say there is long term, if I would be asked what would be my biggest worry in the G10 FX space, it would be Australian dollar. But do I see a collapse over the next few weeks or months? Not necessarily. Because still Australia has highest interest rates in the G10, and also I think that Australia may in part benefit from these flows out of Japan when Japanese investors are going to look for alternatives. Because in a sense, Australia from that could be attractive. High yields, regional proximity, because Australia and New Zealand dollar are the only G10 currencies in the Asian Pacific region, and also AAA rating. And when AAA assets are getting scarce or scarcer, as we have seen the last Friday with the UK, it can provide some support for the Aussie dollar in the near term. Is it going to last? No, because the fundamentals of Australia looks pretty shaky.
If you think the Australian fundamentals look shaky, then you must be very negative on New Zealand.
Yes, to be fair, I think it is a very similar story. Current account deficit, persistent current account deficit, high net foreign international liabilities. They also, from a valuation perspective, also very expensive. But on the margin, I would expect New Zealand dollar to outperform the Australian dollar. One of the reasons is that it doesn't have such a exposure in terms of hard commodities to China.
Sure, but there's only one thing that's keeping the Kiwi dollar up at the moment, and that's one-way investment from China. I'm ex-Australian and actually from Barclays Australia, but I actually don't agree with your synopsis there, because I actually think that I trade from a long Aussie short Kiwi perspective from that cross, because I personally think that the New Zealand dollar, from the small economy, and the only thing that's keeping it up, as I was saying, or what I was arguing, is the Chinese investment. There's just not enough. I actually think that the Australian dollar will be bought on probably all dips. I can see it maybe going briefly below parity, but I can't see it going to 95. I just think there's too much demand out of Japan.
No, I agree, and
ongoing Toshin investments that pouring money from Mrs. Watanabe's all the way through.
Sure, I very much agree. I think that there will be a positive effect in the short term, but also in terms of these flows from Japan and Toshin funds, one has to be also aware that these Japanese investors already have a meaningful positions in Australian dollars.
Oh, sure.
Hence, probably they are not likely to put all the eggs in one basket, and they will be looking for alternatives. And this could be, as I said, the euro area, or it could be also in terms of emerging markets. It could be Mexico, Brazil, it could be, for example, Turkey, though I'm not like particularly bullish on the Turkey. But what I would say there is that I see a support for it in the short term. But again, the fundamental story for Australia is pretty weak. So honestly, in the long term, 1 year, 2 years, even more, this is a currency where I see a massive downside risk, precisely because what has been happening there. Because to me, it's just not unbelievable, but it is noteworthy that if you are a country with which benefited from this massive rise of China, and yet you managed to run current account deficits and you indebted yourself pretty meaningfully, then the question is, what is next?
I don't doubt that on balance it probably should be 85 cents, but the fact that the market has been considering that in the back of its mind, because the Australian dollar used to be a prime example of a currency that would go up by the stairs and down by the escalator, to use the analogy, and that's been sort of almost pretty not quite opposite, but it's been very different for the last 3 or 4 years.
No, I think that over the last 2-3 years, like Aussie was like trading, like is there in a sort of this risk on risk of fashion, up when market was alright, down when market was scared. But now again, if we think that, and this is, I'm going back to this theme of great differentiation, if we think that currencies will no longer trade in blocks, and investors will start looking in fundamentals, then fundamentally I think that I would be probably rather in Swedish krona or Norwegian krona than in Aussie, even though I get some 1.5% pickup in yield, but in Aussie. But still, this risk and this like weak fundamentals, this is something I would be really, really concerned about. Yes?
Could you just give your view on ways to the Norwegian krona?
In terms of the Norwegian krona, our view mainly against the euro is a gradual appreciation to 135 6 months, 130 12 months. Again, I think Norwegian is fundamentally sound country. It obviously it benefited from in terms of fiscal position. It benefited from the windfalls from their oil industry. Of the economy is doing right. Interest rates are around 1%, so still not bad in terms of what's happening elsewhere. But again, I would see it as a cyclical currency. There was sort of, I remember last year and even mainly 2 years ago after the US downgrade, there was this cottage industry developing and everyone was looking for the next new safe haven, and like people were talking about Norway, about Sweden or even Singapore. Again, I would very disagree with that. Even though there are strong fundamentals in Norway, stable AAA rating, and the economy should pick up from now on, still, it is not safe haven by any chance. It is a cyclical economy. It cannot be safe haven because for you to have a currency where investors go during the periods of risk of environment, the currency must be liquid. There must be high pool of assets you want to invest in, and obviously you must to have this sort of trust from the past. And Norway doesn't tick a box in any of these cases. I think that even Norwegian krona is the lowest liquidity currency in the G10 FX. So from this perspective, I wouldn't see it as a massive like new safe haven. But I think that against the euro, it will continue appreciating because fundamentals are strong, and also again currencies are about relative value, and we think that the euro will remain pretty weak over the next few quarters because of the weak economy, divergences among the countries, among the member states, and also pretty dovish ECB. So, but I would also say while I am reasonably constructive on the Norwegian krona, I wouldn't, again, against the euro, expect there like a massive gain, so you won't probably see 15% appreciation over a year, because Norwegian central bank, the Norges Bank, has a pretty long history of intervening or leaning against currency appreciation. And I think we We have seen this last year when they surprisingly cut interest rates by 50 bips. By 50 bips when the Norwegian krona was in the time one of the strongest currencies in the G10. So there, what I would expect against the euro is gradual appreciation, but I wouldn't expect there 10-15% gains precisely because of the policy stance of the Norges Bank. Any other questions? Excellent. So I guess that's it. And now I would pass the final remarks to my colleague, Peter.
Indeed. I hope you all agree it was a very engaging and thought-provoking session. Just one last note, there are some printed copies of both presentations for you to take home. Also, there will be soft versions posted on the Barclays Margin FX website in due course. At the moment now, what we would like to do for you is have a run-through of the Barclays Margin FX platform by one of our specialists, Kit Owens, who will go through, it's just a 15-20 minute tutorial showing you the benefits of the Barclays Margin FX platform, plus any questions you may have. Also, after that, there are some laptops over there. They will be switched on. At the end of that, you come over and ask as many questions as you have. Thank you much indeed. Kit has just got to be mic'd up. Okay.
Thank you, Peter.
No problem.
Good afternoon, ladies and gentlemen. My name is Kit Owens. I believe I've spoken to some of you, a few of my colleague may have spoken to a few others. Just bear with me a second while I bring up the platform. So the main focus for me right now is just taking you through the platform. I hope some of you are quite familiar with it. If at any point any of you have any questions, if anything that I'm covering, feel free to stop me anytime and just jump in. I'm more than happy to kind of open questions as we go along. So with the platform itself, there's two functions. There's the platform where you can deal from, and there's also the charting package that goes along with it, called MarketScope. Now, to make you aware, depending on what operating system you're using, you're going to be restricted to using the web-based version. If you're using a Mac, if you're using a desktop, Microsoft, I recommend you to download the platform itself, purely because you get the functionality with it. When I say the functionality, I'm referring to just here, you see there's a second tab at the bottom. This is MarketScope. This is the charting package that goes along with it. I will go into MarketScope in more detail towards the end of the presentation. But with my point on the web-based version, it's restricted in the sense that you can only trade with you can trade off the chart, it's not a problem, but it's actually embedded to that actual platform itself. So if you see here, you've got advanced dealing rates along the top and simple dealing rates. Next to that, then you'd have your chart just there. So that's one of the drawbacks with it. So depending on, like I said, what operating system you're using, I'd recommend going onto the Barclays Margin FX website and downloading the software onto your laptop. So to give you kind of a brief explanation on what kind of separates Barclays Margin FX from pretty much the core of the market, we do a non-dealing desk execution. I'm not too sure if some of you are familiar in terms of that terminology. But essentially what it means is the fact that we're not on the other side of your trade, in short. So, bear with me a second. So companies like, not to name any names, but when you are trading, you're an anonymous trader. So no one can see your stops, your limits, your balance, and what your name is. When you basically place a trade, your name it comes up as Barclays. So you're going through to our liquidity pools, ourselves, and some of the banking relationships that we have. On the other side, you've got something called a market maker who take the other side of your trade. So they can restrict you in terms of your trading. So you can be restricted in terms of you being requoted. They can stop hunt you. So there's a number of drawbacks with it. fundamentally, the main point is that there's a conflict of interest between you and your broker. So when you make a loss as a client, they make a profit and vice versa. So anytime you make any profits, you're taking out of that revenue stream. So in their business interest, it's not in their interest for you to be successful. As ourselves, it's certainly in our interest. For the pure fact is the only way we generate any profits from you as a client is through the spread. I'll show you where the spread is in 1 second, and also the rollover. But that's also a positive and a negative depending on what pair you're trading. So these are pure facts that you need to bear in mind when looking at other companies as well. So going on to the point of what I was just saying in terms of the spread, the two main focus here is the sell and the buy, just here, and then the spread just here. So we're taking the best bid and ask price from our liquidity providers, and we're then passing it on to you with our spread, which is effectively our commission and how we, as I said, one way we generate revenue as a business. From that, we also have the position. So at this moment in time, does anyone have any questions at this stage in terms of the outlook or how you're trading? No? Perfect. Okay. So there's two functions when you're using it. There's both a left click and a right click. If I just show you a right click now, you can see that brings up a lot more information and functions for you to trade. If you left click when you're opening a position on the actual platform itself, if I do it now, it will just open up a market order. Now the detailed information within this will be your account number. This is purely down to your account, so when you set up a live account, this will be bespoke to yourself. That will never change, and there's no way of putting it down. If you click on advance, that will then bring up the stop and the limit. So if I just run through these. So as you saw, I just left clicked on the buy of $yen. If by any mistake you feel like you didn't mean to do that, you can swap it. So in the market order, you can change pretty much everything within it. Also within this, you can change the amount that you're trading. This is the notional volume that you're trading. So just here you've got a 10K lot. This is a mini lot. This is the smallest denomination you can trade with Barclays, and this grows up in increments of 10. So just to kind of multiply it by 10, go to 100. If you just notice just beneath that, you see it says per pip. That's what you're trading per point, and just there's which stands for used margin. That's the required deposit for you to open up that position. So if I could just go back again to see the difference, it calculates and configurates it for you. I'm not too sure if many of you have used MT4 or anything like that, but one of the drawbacks of using an MT4 is that it doesn't do the calculation for you. It tells you, if you say, for example, you open up 1.00, that's the equivalent of a standard lot size, but you don't ever know, unless you do the calculations yourself, how much you're trading per point. So if I just leave it there for the time being. Then you're also able to control your slippage. So at the moment it's at market. So we offer best bid, best offer execution, and we'll aim to fill you at the best available price at market. Market range itself is for you to control some slippage. So depending on what kind of pairs you're trading, I know Petter talked about looking at quite some, not kind of exotic pairs, but not typically majors or yen crosses where the liquidity pools aren't as big. With that, depending on what kind of volume you're trading, it's important to kind of manage your slippage, and within market range you can do that. So if you can see, you can control it here, and it's fully adjustable within it. Following that, you also have time and force. Now, please bear in mind, when you're trading on the order type of market range, you're restricted to an IOC order or an FOK order. An IOC is immediate or cancelled. What that means is that it's going to give you a partial fill. So say, for example, there's 100K available at that one time in terms of liquidity, and you're looking to put an order for about 150. What it will do is it will fill your order at that available price for 100, and then when the other 50 comes available, that's when it will fill you. And then fill or kill, it will either fill your order at that available price, or it will kill your order completely and you won't enter the market. So going back to at market, you've also got good, kill, cancelled. So that will fill you, as I was saying, at the best available price at that moment in time. Following this, you also have your stop and your limits. You can control this depending on the rate that you're looking to achieve, or at the very bottom, you can do it in pips. So it just depends on what kind of trader you want to do and how you want to manage your profit and loss as a client. So let me just put something in just here, just to have an order open. press enter, and you'll see the trade just been executed. At this moment in time, does anyone have any questions for what I've been going through?
It's actually an order rather than click and deal instantaneous price.
Sorry, sir.
So if you're putting in an order, that implies that your prices are indications rather than firm prices. So it's not click and deal.
What do you want to say? What you want to do? One click or?
No. You're asking people to fill in an order,
Mhm.
right? So that implies that the prices that you're displaying aren't firm prices, they're indications.
No, just to be clear, they are the prices that are available at that moment in time.
So then, why can't you just click and deal? So I see you put the order in,
Mhm.
and you've almost got instantaneous fill on the order.
Yes.
But just out of interest, why are you saying it's an order as opposed to just an instantaneous?
What we're looking to fill, depending on what kind of volume you're doing, we're looking to fill you at the best available price. So as I was saying, depending on what order type you're doing and what you're trading, these are things that you have to consider, because bearing in mind that you're dealing in, everyone in this room is trading right now. And if that order, if you say you want 1 million of dollar yen and there's only 500,000 available, then there's going to be slippage within that. So that volume has to be physically there for you to get execution.
With the size and depth
Yeah.
of the FX market, and
Oh, it's huge, but I'm just saying hypothetically speaking, yeah. I just obviously don't want to.
so is there price latency built in or not? No, it's so from the time that you click on the order,
Mhm.
it's an instantaneous. There's no automatic latency in the feed or not. No?
We don't offer instant we offer execution
On an order basis.
on order basis, yeah. So if you say, for example, you see just here, you're looking at euro dollar, it's at 130.47. If you clicked it now, you'd get filled best to that price just there. If the latency in terms of you putting up the ticket is an issue, you can control that. So if you just want to do one-click trading and you want to be in the market straight away, that's a very good question. Thank you for bringing it up. You can click on something called trading settings. So you can do one-click or double-click trading. So if you go onto one-click trading, again, you choose your order type, market order, and again, the stop and the limit's also available. Click OK. You'll see that a disclaimer comes up, because at this moment in time, you're enabling something called one-click trading. From where we are, when we're giving you the platform, you have the control to say you can cancel the order when you have the ticket itself. If you click OK, I'll show you what happens. You see just here, it's just changed to a 1 before it was blank. You can also do double-click trading as well, and that figure will turn to 2 just here, and the icon will go blue. To answer your question, if you start clicking, then it's just sent to your trade just there.
Okay, second question on your stops.
Yes.
With the stops, your stops only triggered once the market's traded at that price, rather than the price displayed on the screen. The reason I ask is some of the spread betting firms, for instance, like IG Index as an example, even if the market hasn't traded at your stop level, they may still stop you out if they're displaying the price
Okay.
on the screen.
Well, you're actually helping me out more than anything. It's just kind of, I don't like to name names, like I said, this doesn't benefit anyone, but like I said, IG, they're a market maker. So within their terms and conditions, if you see section 2, I believe it is, on the terms and conditions, you kind of usually find it halfway, so you can read the top or the bottom, you kind of scan through it, and you miss that part of the terms and conditions. But within that, they say there's a conflict of interest between you and themselves. If they are regulated by the FSA, they, as a business, they have to disclose how they generate their revenue. And in part of that, they can say we can control the market. So they can move the market. So say, for example, everyone here has a stop around 130.20 on euro dollar. And they can see the pool of depth, how many people are there. They're like, well, we can move the market, we can take out a chunk of our book, limit our exposure, and then come back. Again, because if everyone here hits their stop or their limit, if there's a stop, fantastic. They've then made a profit. If you all hit your limit going above that price, then they take a significant loss as a company. And you only have to look at the cases of MF Global, World Spreads, that went under, taking huge client losses from when their clients were profitable. I mean, for us, fantastic. You make a profit, brilliant, because it means you're going to be trading more with us. I mean, we wouldn't be putting on sessions like this with Petter and Alejandro to help educate you. I mean, we have an abundance of information. We want you to be trading and making money. I mean, it's a win-win situation for both parties. So to answer your question, no, we don't control the market. We're giving you the best bid, best offer execution, and you've got a straight-through process to market.
So, but the question on the stops, the market will have had to trade out.
Correct,
stops.
completely, 100%. So hopefully that answers your question in terms of the trading. Fantastic. So in order to close a position, I'll just close off that small one that I just did with the one-click trading. If you just right-click, you can see, again, going back to the functionality, if you right-click, it gives you a lot more options to trade from. So just with close position, you OK that. To also make you aware, you can also do partial, you can close out partial part of your position. This one's a bit small because it's a 10K lot, but you can do it. So say if it's a 100K lot and you only want to take out 50K, you do have the ability to do that when you're closing out position. So I'll just close that. Let me just go back to default. Following that, any more questions in terms of opening orders or anything like that? No, not at all. So previously, when I opened this position, I'll do it again for you, just so you can see it. You see just here, cable, so it says 2.6, just above the sell and the buy price. So I'll open up this. Notice it says 2.6. So you go 2.7. Okay, so just here, that's your P&L in terms of pips. That's the cost to you as a client. So in order to open that position, it's all rolled into one. So you don't pay anything on exit. You pay it all on entry, and that's the commission to us. That's it. Okay. Any more questions with regards to opening positions, closing positions at this stage? Yes?
Show the margins when you are put a trade.
Margins.
Will you show the margins?
I will show the margins in 1 second. Thank you. Right. I'll go on to it now, actually, just to show you. So if you go into simple dealing rates, I just clicked on that tab next to advanced dealing rates. You can still trade off this, this aspect of it. And again, you can see it shows you the spreads, the high and the low of the day, the roll, the sell and the buy, your pip cost. And coming on to yours question, sir, was the margin. We're geared at 100 to 1 leverage, and that's fixed. If for any reason you want to change that or lower it, we can offer that facility for you. We can do a number of things for you. However, we will not offer anything higher than 100 to 1 leverage. You can see people offering 400 to 1 and much higher. As you can see here, everything here is 100 to 1. Okay. So coming on to the actual ticket itself, and I'll go on to your account, which is very important. Your ticket number, it's just I'm focusing just on this line just here. Ticket, that's bespoke to your exact trade at that moment in time. So every time you open an order, that will be bespoke, and that will always change. The account number itself, as I said, will be fixed. It shows you the symbol that you're trading, the amount in terms of denominations of a K, whether it's a buy or a sell, your open, your close, your stop, your limits, your profit and loss in terms of pips, your gross P&L, the roll. Now the roll is charged to you for any positions that are held over 5 o'clock Eastern time, and then following that the time. Now moving along, just bring that along a little bit more.
5 o'clock Eastern time, 10 o'clock used to be 10.
Yeah, so bear in mind it's BST now. So again, your account number. So your balance, that's your balance before you open, and that will stay the same. So when I open this position, the balance would still stick at 49. Now you see the equity. Now this is the most important figure up here, and this is your overall account view. So this is a snapshot of your account. This shows you, with any open positions, your profit and loss. So even though I've opened a position just now there, however, you can put this order in, and when that market reaches that level, it will then trigger that. Again, you could put a stop and a limit, and you could use your risk management in that way. Moving on to market scope, which is, again, as I said, the charting. How many people are familiar with market scope and trade-off charts, just to kind of get a rough idea? Perfect. Okay. Personally, I'd like to have 4 charts up, just so I can get an overall snapshot of how a pair's been trading over different time frames. So if you go on to File, Create Market Shot, what it does is creates a second tab. See, it's just created here along the top. What I'm going to do is create 4 of them just now. Okay, now what I'm going to do is left click and drag it onto the middle of the screen, and then you see it just places it along the side. Again, I'm going to repeat that process, left clicking, holding it down, and then you can get an overview. Now what I'm going to do is change the time frames, which is just the third one along, so 5 minutes, 15 minutes, 30 minutes, and then an hourly chart. Now what you can do is you can also link them all together. Now all these charts are bespoke to itself, so when you add an indicator, which I'll show you in a second, when you add, say, a MACD or a Fibonacci, it will be only for that one chart itself. It won't be for all of them, even though they're all linked together. So to link them all together, just in between the symbols, so you've got a list of your 20 symbols just there, link them all together. Now if you change it to, say, cable, you'll then see that cable shows you over those time frames. So depending on how you like to trade, it's just a very useful piece of kit. And then again, if you right click, you can see you get an abundance of information here in terms of options. So as I said, to add an indicator, this gives you a list of 30 of the most popular or most common indicators and oscillators. If there's any indicator or oscillator there that you feel that you need to use, contact myself or Alex. I'm sure I'll introduce you to them at the very end. But you can import them, so it's not a problem. If you just click on here, and then you can load up that specific indicator or oscillator to add to it. Again, you can trade off the charts, as I said previously. So for, again, an entry order, a market order, you'll see it's there. And say you can see right now it's kind of going through a bit of a flat range, but it's come off earlier. Sorry, over last week it came down, and you believe it's going to go up. You can click on the limit, and you can move your limit just there. It'll ask you to confirm that you're doing that. You can see your limit has been broken down in terms of what you'll be making profit. And you can see that it's moved its range just there. Again, if you just left click, you drag and hold, you see it's moved it. So you can move your stop and limit off the chart, and you can trade off it. Again, in terms of the position, you can also close the position on the chart, and that's the position closed out. In terms of kind of a run of overview, the best way you're ever going to understand how to use the platform and being what kind of trader you are, because everyone's very different in terms of if you're an intraday trader or you're holding positions overnight, it's most important that you go away and use the demo itself. So if you go onto barclaysmarginfx.com, you'll find that you can set up a free demo account there. If you have any questions, once you set up the demo account, if you put your actual information down, majority of you, I've already spoken to anyway, so we have your information anyway, but feel free to contact us, we'll be more than happy to help you. In terms of just a general overview of the platform and market scope, does anyone have any questions at this moment in time? Yes?
Very simple question. Now this is, you can tailor the view of this pretty extensively.
Correct. You can change everything on it. So in terms of the color configuration, everything, depending on where you are as well. If you go to File, you can change just go to default layout, that'll go back to it. But mainly in terms of you changing the kind of download, if you go to Options, you'll see that just here in these little boxes, you can change the colors within that. The only colors you can't change is the updating of pricing of the red and blue. Hopefully none of you have a problem with red and blue. I shouldn't see it as being too much of an issue. The most common thing, thank you for bringing that up, is the changing of time fields, depending on where you are globally. You can change that, and that will then change it on the chart itself. So if you just click, so what I've done is I've gone to Trading Settings, General Trading, third from bottom, View Format of Time, click on downwards, and you've got UTC Server, Local, and that will then change depending on where you are. So hopefully that answers your question just there.
The question I was going to ask,
yeah.
I'm glad you brought that out, but the question I was going to ask is, when you log out of the web version, depending on...
What operating system? Go on, sorry.
NT.
Okay, yeah.
So depending on how long you're logged out, when you come back in, your customized settings are gone, and it returns to default. I haven't found out how you save your customized settings.
Okay. So what you then do is, if you're using your Microsoft, I'd certainly recommend downloading it because that will stop it from happening in future. The web-based version could only store.
Yeah, no, I do it on my desktop, but when I'm travelling,
Okay.
I use the web version.
So what you then do is this for the layout itself on the charts?
Layout.
Yeah. So you then go to File, Layouts, and then you save your layout just there. So what I've done is just gone to File, gone to Layouts, and then you can store the layout. So next time you log back in, you just go to Open Layout, and then that'll open it back up for you.
Brilliant.
No worries. Yes, sir.
If you put, for example, a stochastic and you've got the support and the bar across the bottom of the line,
Mm-hmm.
can you then enter another one without that one making a whole tier up? Can you flick it to one side and substitute it and bring it back?
What I'd recommend, Mark, is you probably putting it on a second, if you want to do it like that, otherwise it will just stack them. And if you want to obviously see
Not
more,
stacked, but just
yeah,
put it to
exactly.
one
So,
side, bring one in.
yeah, you'd have to remove it to do that. But in order for what you're doing, desktop,
And is there a tutorial when you are practicing your...
we do have a tutorial. So if you go onto our website, there's I think it's about 10 to 15 minutes of video footage, and it covers pretty much what I've done today. And there's a few other things that I may have covered, but I think I've covered the core of it. Yeah. So yeah, if you go to Barclays Margin FX, and then if you go to Trading Platform, I think it's the third tab across the top.
Because one can't
Yeah.
take everything in one go. You
That's fine. It's fine. So yes, sir.
So have you found the account? How do you bring money into the platform?
How do you bring money into the platform?
Yeah, it's one.
So when you open an account, you go through the application process. You do this online. Once you complete the application process, you then go through the funding. The funding can be done in one of two ways. You can do it via debit card, and you can also do it via wire transaction. On the first instance, we do it via BACS, which is free of charge to you. It takes between 2 to 3 working days. But the reason why we do that is because it carries a lot more information, and we can get a way of taking one more document in terms of certification from you. Once you've then funded your account, that will then be reflected on the balance just here. Just here. Once you've deposited funds, there's no cost for withdrawing or depositing funds. Withdrawing funds, when you set up the account, you nominate a bank account. So you bank with Barclays, you have a current account with Barclays, that's your nominated bank account. So any withdrawals you make as a client, that will then go back to that nominated bank account. Again, same for depositing. If you want to deposit for a different account, you do have the ability to do so, and you can do that via wire or debit card. We do not accept any credit cards transactions.
So you hit the 30% and you want it on your account, it's still going to take 2 or 3 days to clear.
No. So in that case, what you do, you'd do it via debit card, and that pretty much hits instantly, or you could do it via CHAPS, but I'd recommend doing it via debit card. Yes, sir.
Have you got any news on mobile trading?
Well, the mobile app, looking at the back, we're looking to have it implemented very soon. Do we have a date as of yet?
No, it will be the second quarter of this year. It's one we have a roadmap internally, which we work on things. The mobile app is one of the things you gentlemen and ladies have requested, so it's on our list of things to do.
Yeah.
So we'll be hopefully be with you. We're in the process of building it as we speak. It should be with you the second quarter this year.
And what we're doing with Barclays Margin FX has been running for 6 months. And this is certainly a longevity thing. And every day I speak to people like yourself, new clients or prospects that are looking to set up an account. I take a list every single day of client requests. And as time goes on, we're looking to develop and implement these. Mobile trading was one of the first. There's many more in terms of kind of gold, silver. Just if there's anything you feel like that we can add to the platform, when we have the time and infrastructure to do it, we will certainly look to implement it if the request is certainly there. Mobile trading, having it on your iPad, these are all things that we're looking to, like Peter said, implement very soon.
Kind of transferring funds between various Barclays trading platforms, MarketMaster and international trading.
That's on a back office side, but yes, that will be available. We'll be able to do that. That won't be a problem. I'll take it you have a MarketMaster account? Yeah. If it's something you want to do, then just pull me aside at the end and we'll discuss that further. Do we have any more questions? Yep, so,
Do you see your charts?
yes?
Now, can you superpose other currencies on the chart? Let's say, at the moment, what you have there,
Mhm.
pound, US dollar,
Yeah.
full euro, US dollar, and then euro, yen,
Mhm.
and then how to look at all three.
So what I could do is unlink them, as I was saying. So if you just done that, unlink, and then say you trade just on 5-minute time frames, for example, set all these to 5-minute time frames. You can then have euro yen. Oh. You have to unlink them all afterwards. If you click link all, it'll link them all instantly, but to unclick them. So yeah. So now you've got 4 different currency pairs over 4 different charts, and then you can control the time frames there.
You see, it's a bit messy. Instead of separating them, instead of messy, it's much more to
Sorry?
It's quite messy. It's all clumped together.
Mhm.
You separate them. I mean, for example, if you on the same chart, rather than in 4 different blocks,
Mm-hmm.
so you have euro yen, let's say euro USD, pound USD, on just one chart, rather than separating all into 4 different charts.
Oh, right. So you only want to have one chart?
Correct.
Okay, so if you just click the cross at the top, you'll close all these windows, and then you just have one chart. When you...
No, what we're looking now is
Euro Swiss.
Swiss franc. Now, on this same chart, can you have 3 other currency pairs?
Wait, oh, you can. Oh, sorry. Yes, you can. My apologies. So yeah, if you just click OK, and you just pull it off, you can see you've got it there. Is that what you mean?
Yeah, that's all. I mean,
I'd say what I'll do is at the end.
4 currencies displayed on the same board, on the same chart.
Yeah.
Like comparative charts.
Yeah. What I'll do at the end, I'll sit down with you. We've got 4 laptops over there, and I'll show you exactly how to do it. 'Cause at the moment, I'm not understanding. Yes, sir.
A general question on tax. Trading here, is it subject to capital gains tax?
Or income tax, yes. I'm not qualified to give you any tax advice whatsoever, but what I can say, depending on everyone's position in this room, it's going to be very different. So what you have to do is speak to a financial advisor, and they'll be able to give you, or basically tell you what the situation is in terms of capital gains or income tax.
And your funded account, is that there an interest to return over?
It's on your profits. It's on any profits you make.
Okay, but there's no interest element for the unused balance on your...
So no.
If you click across again, we'll just reverse back to, when you brought that, it went to 2, and then it went to 1.
Mm-hmm.
If you keep clicking across, we'll just go back.
No, you'd have to add it again. So
You have to do it again.
yeah, you have to go through the whole process again. Yes. Yes, sir.
Could you show me how to rearrange your trades? Sometimes you have trades that you want to keep on within a day, and sometimes you've got trades on, and they all come get mixed up.
Oh, what in terms of when you have open positions at the bottom?
If you've got about 6 or 7 or
They're set in terms of time. So you see where it says here, the time just here.
right. Say you opened a euro dollar position, then you opened
What?
dollar yen, and then you opened another euro.
Yeah. So if you double click on the symbol,
Yeah.
you'll see that. Oh, that it's just filtered it that way. Yeah. Do we have any more questions? Yes, sir.
The account activity, so your previous trades, how can you view those and what options have you got?
Again, very good question. So if you go to report, we will run it for today. This will give you your statement summary, and this will show you your positions that you opened. Your information there. So all I did there was I clicked on this icon just here. Usually we'll see report next to symbols. If you click on that, and then you can just pull the report. Again, you can export that from Adobe to Excel, and you can view it.
Do you get emailed to us after days?
You don't know. So if you want to pull off the report, you'd have to do it yourself. Also, just to kind of make you aware as well, we do have a lot more symbols just here. There's only 20 symbols visible at this moment in time. The reason why we have 20 is we did a number of tests in terms of running speeds in someone's internet, computer, and we found the best way of updating a pricing and optimum running speed was to have 20 up. If you have a high bandwidth or a very fast computer and say you want to have all of them up at one time, we can arrange that for you, but you have to bear in mind that it could affect the speed in terms of updating a pricing. So that's the reason why you're restricted to 20. But if you want to say you as a trader, you only trade majors or you don't trade Aussie dollar whatsoever, and you feel like you want to take a position on, say, Swiss Norwegian krona, just click OK, and then you'll probably see that at the bottom. That's just been added, just there. There's one more question. Yes?
How long are the reports sort of kept live for?
So it's backdated to your history of an account. So just type it up. Yeah.
Constantly on there.
Exactly that. At the back, sir? Sorry? Those products aren't available at the moment. Again, a huge request for gold and oil. As I said, we're basically building a list, and over every quarter we're going to be rolling out new additions to the product, to the range, and when they're available, we will certainly let you know. We'll send it out via email to everyone on our book. Let's say you're now available to trade gold and silver or oil when it comes available. Sorry, so go on.
No, I was just going to say, Kit, I don't know how experienced the room is, but one of the best things on this platform, I think it would be good if you showed people that they can actually close out all positions with one click, which is very useful if you are
Thank you.
super duper in the money,
Yeah.
or if you're suddenly shitting yourself.
So thank you very much for pointing that out.
No,
Again,
it's one of the best things on this platform, because for anyone who's an active trader who suddenly finds themselves in a rampant market and go, bloody hell, wow, or
good times.
I'm really not sure
Yeah.
about this, bang, and they're out, and they can think again.
Again, if you just right click, it brings up all those positions. So you see close position. The option there is close all positions. You'll see then it's just got the ticket number, the amount, and your P&L in pips. Click OK. It will close all your positions. Thank you very much. Yes, sir? How can you withdraw? The withdrawal process, if you call us, we will then send that money back to your nominated bank account. Yes?
I'll comment on the American, the first Friday of the month.
Non-farm payroll on Friday.
Yeah,
Yeah.
on payroll last Friday. I had a position and it went right through it.
Mhm.
How would I better protect myself?
I can't give you any trading advice, but one way to control it would be to have a stop and a limit. In your experience as well as a previous trader, the majority of people don't trade around huge fundamental announcements like that, purely because of the uncertainty. If, say, Barclays, JP Morgan, their prop traders don't know where the market's going to go, chances are you probably won't either. So in short, there's only the risk management is the stop and your limit, and then you not overexposing yourself to the market, not over leveraging, having, say, for example, you've got a balance of, say, 50,000 and you've decided to open up a position, say, for example, on Euro, Kiwi for some reason, just saying, for example. You can see if you go to, 40,000, you're trading at £220. You see the margin will change significantly here. You're probably already in a margin call at this moment in time. Again, that pops up. You've hit your 20%, your calls come up. Again, that comes down to your risk management, not over leveraging, using stops and limits. Do we have any more questions? Yes, sir.
How much does Barclays Margin FX charge? Do they charge when you open the position, close the position, and how much? And can we see it in the?
It's just so if we come up, just here. So as I was saying previously, the way Barclays Margin FX generate revenue from you as a client is through the spread and the rollover. The rollover can be debited or credited to you as well. That's based on where the interest rates are. But between here, you see the spread. That's the cost to you as a client. So when you open a position, that's the charge to you. You don't pay that on exit. You pay that on entry. That's all rolled into one. So the cost to you is 2.6 pips. So depending on what you're trading in notional volume, that will then reflect what you're trading per pip, and that will be a cost of X. Okay. Okay. Do we have any more questions? If anyone has any more questions, we've got some laptops here, so feel free to use the platform. Myself and my colleague Alex would be more than happy to answer any questions. But thank you very much for coming today. Pleasure to meet you all.